Most traders learn the order pairing concept and immediately start looking for entries. They see opposing candles. They identify what they believe is institutional buying or selling, and then they enter the market simply because price returns to that area. But order pairing was never designed to be used as a standalone entry signal. It can help you understand how price is being delivered. It can help you identify potential institutional intent, and it can help you anticipate which side of the market may be targeted next. But it does not automatically tell you when to enter a trade. That is the part many traders misunderstand. In this video, I will show you how to use order pairing correctly by combining it with higher time frame direction, liquidity, key institutional levels, and confirmation candles such as an engulfing bar or a key reversal candle. By the end of this lesson, you will understand how to move from simply identifying order pairing to building a complete and structured execution model. Before we discuss entries, let us first understand what order pairing represents. Every transaction in the market requires a buyer and a seller. When a large institution wants to buy, it needs enough sell-side orders available to fill that position. And when a large institution wants to sell, it needs enough buy-side orders on the other side. This process of matching buy and sell orders is known as order pairing. Because institutions trade with significantly larger positions than retail traders, they cannot always enter or exit their entire position at one price. They need liquidity. They may use areas where stop-loss orders, pending orders, and breakout orders are concentrated to facilitate their transactions. This is why liquidity and order pairing are closely connected. Price often moves toward liquidity because those areas contain the opposing orders required to complete larger transactions. For example, imagine that an institution wants to establish a large bullish position. The institution needs sellers. Where can those sell orders be found? They may be found below an old low, where traders have placed their stop-loss orders. They may also be found below equal lows, below a previous day's low, or underneath a clearly visible support level. When price moves below that liquidity, sell orders are activated. Those sell orders can then be paired with institutional buy orders. If strong buying enters after the liquidity is taken, price may begin delivering higher. However, the liquidity sweep itself is not enough to justify an entry. You still need to determine whether the market is operating from a meaningful location and whether price is confirming your directional idea. This is where many traders make their first mistake. They identify an order pairing sequence but ignore the surrounding market context. They may find a bullish pattern while price is trading directly into higher time frame resistance. Or they may identify bearish order pairing while price is sitting at a major higher time frame discount area. They focus on the candles but ignore the larger narrative. Order pairing should never be analyzed in isolation. Before using it for execution, begin with the higher time frame direction. Ask yourself where price is likely trying to move next. Is price seeking buy-side liquidity above an important high? Is it seeking sell-side liquidity below an important low? Is the market expanding, retracing, consolidating, or reversing? Where is price positioned within the higher time frame range? Is it trading in premium or discount? These questions provide the context that the order pairing pattern alone cannot provide. For a potential long position, I would generally prefer to see price trading from a higher time frame discount area, or from a level that supports a bullish market narrative. I would also want to identify a logical liquidity target above the market. For a potential short position, I would generally prefer to see price trading from a higher time frame premium area, with a logical liquidity target resting below. Once the directional framework is established, the next step is to identify where the reaction may occur. This is where key institutional levels become important. These levels may include a fair value gap, an order block, a breaker block, a mitigation block, or another clearly defined point of interest. However, identifying a level does not mean we immediately place a trade when price touches it. A fair value gap is not automatically an entry. An order block is not automatically an entry. An order pairing is not automatically an entry. These elements help us build a trading idea, but the market must still confirm that idea. Let us look at a bullish example. Imagine that the higher time frame market structure is bullish. Price has been delivering higher, and there is a clear pool of buy-side liquidity resting above an old high. Before continuing higher, price begins retracing. During the retracement, price moves into a bullish fair value gap that is also located in the discount portion of the current dealing range. Below the fair value gap, there are equal lows or another visible source of sell-side liquidity. Price trades below those lows, activates the sell orders resting underneath them, and then returns inside the fair value gap. At this stage, the conditions are becoming interesting. We have a bullish higher time frame narrative. We have a clear liquidity target above. We have price trading from a meaningful discount area. We have a fair value gap acting as our point of interest. And we have sell-side liquidity being taken. But we still do not enter. We wait for price to confirm that buyers are taking control. One confirmation we can use is a bullish engulfing bar. A bullish engulfing bar occurs when a strong bullish candle overtakes the body or the meaningful range of the previous bearish candle. It shows that buyers have responded aggressively enough to overcome the immediate selling pressure. The quality of the confirmation matters. A small bullish candle appearing anywhere inside the zone is not necessarily enough. I want to see clear intent. I want to see the market reject the lower prices. I want to see a strong bullish close. And ideally, I want to see some form of displacement away from the level. The engulfing bar becomes more meaningful because it is forming after liquidity has been taken and at a pre-identified institutional level. This is the difference between trading a candle pattern and trading a complete market narrative. The candle pattern is simply the final confirmation. It is not the entire reason for entering the trade. Another confirmation that may appear is a key reversal candle. In a bullish scenario, price may first trade below the low of the previous candle, taking liquidity underneath it. Price then rejects the lower prices and closes strongly above the previous candle's close or above an important part of its range. This tells us that the attempt to move lower has failed and that buyers may be taking control. Again, the location is essential. A bullish key reversal candle forming in the middle of an unclear range may have very little value, but the same candle forming after a liquidity sweep inside a bullish fair value gap or order block and in alignment with the higher time frame direction has much greater significance. The market context gives the candle its meaning. Once the confirmation candle closes, we can begin planning the execution. Depending on your execution model, you may enter at the close of the confirmation candle. You may wait for a retracement into part of the confirmation candle, or you may refine the entry using a lower time frame fair value gap created by the displacement. The exact entry method can vary, but the logic should remain consistent. We are not predicting that the level will hold. We are waiting for price to demonstrate that the level is being respected. The protective stop should be placed at a logical invalidation point. In a bullish setup, this may be below the liquidity sweep, below the confirmed swing low, or below the institutional level that supports the trade. The stop should not be placed randomly based only on the amount of money you are willing to lose. Your monetary risk should be calculated from the technical invalidation point. First determine where the trade idea becomes invalid, then calculate the correct position size so that the loss remains within your risk limit. Your target should also be selected before entering. The target could be an old high, equal highs, the previous day's high, external range liquidity, or another clear source of buy-side liquidity. This creates a complete bullish process. First, establish the higher time frame direction. Second, identify the liquidity target. Third, wait for price to retrace into a meaningful institutional level. Fourth, observe whether opposing liquidity is taken. Fifth, evaluate the order pairing and the reaction from the level. Sixth, wait for an engulfing bar, key reversal candle, or another valid confirmation. Seventh, define the entry, invalidation point, and target. Only then do we have a complete trade setup. Now let us reverse the process and look at a bearish example. Imagine that the higher time frame direction is bearish. Price is expected to deliver towards sell-side liquidity resting below an old low. Before continuing lower, price begins retracing upward. The retracement reaches a bearish order block located in the premium portion of the current dealing range. Above the order block, there are equal highs or a clearly visible previous high. Price trades above those highs and activates the buy-side liquidity. Breakout buyers may enter because they believe resistance has been broken. At the same time, stop-loss orders from short sellers are also triggered. These buy orders provide the liquidity needed for larger sell orders to be paired. Price then rejects the higher prices and returns inside the bearish order block. Once again, the setup is developing, but we do not enter simply because liquidity was taken. We wait for bearish confirmation. A bearish engulfing bar may form, showing that sellers have overtaken the previous bullish candle. Alternatively, a bearish key reversal candle may trade above the previous high, reject that movement, and close strongly lower. This gives us evidence that the move above the highs may have been a liquidity event rather than genuine bullish continuation. After the confirmation closes, the entry may be taken according to the execution model. The protective stop may be placed above the liquidity sweep or above the confirmed swing high. The target may be the old low, equal lows, the previous day's low, or another clear sell-side liquidity objective. The same process applies in both directions. Context comes first. Confirmation comes second. Execution comes last. There is another important detail traders must understand. Not every engulfing bar should be traded. Not every reversal candle should be traded. A candle pattern becomes valuable only when it forms at the correct location and supports the existing market narrative. This is why I use confirmation as part of a sequence rather than as a standalone strategy. For a valid setup, I want several elements working together. I want higher time frame alignment. I want a clear liquidity objective. I want price trading from a meaningful area. I want evidence that liquidity has been taken or that opposing orders are available. I want the order pairing to support the directional idea, and then I want confirmation that price is ready to move away from the level. When these factors align, the trade has a stronger foundation, but even then, there is no guaranteed outcome. Confirmation improves the quality of the decision. It does not remove risk. Every valid setup can still lose. The purpose of this framework is not to predict every market movement correctly. The purpose of this framework is to create a repeatable decision-making process that tells you when the conditions are strong enough to justify taking risk. Let us also discuss a common situation that should result in no trade. Imagine that price reaches a bullish fair value gap. The higher time frame direction appears bullish and there is liquidity resting above the market. However, when price enters the fair value gap, it does not show any meaningful rejection. There is no bullish engulfing bar. There is no key reversal candle. There is no displacement. Price continues closing weakly and eventually trades through the entire level. A trader who entered immediately when price touched the fair value gap may be stopped out. A trader who waited for confirmation would simply remain outside the market. This is an important principle. Confirmation does not only help you enter trades, it also helps you avoid trades that were never ready. Missing a trade because price moved without giving your confirmation is not a failure. Your job is not to participate in every market movement. Your job is to take the trades that meet the conditions of your framework. There will always be another opportunity. Let us summarize the main mistakes traders make when using order pairing. The first mistake is treating order pairing as an automatic buy or sell signal. The second mistake is ignoring higher time frame direction. The third mistake is identifying the pattern without identifying the liquidity objective. The fourth mistake is entering at a fair value gap or order block without waiting for confirmation. The fifth mistake is taking candle patterns in the middle of a range rather than at meaningful levels. The sixth mistake is chasing price after the displacement has already occurred. And the seventh mistake is placing the stop based on emotion rather than at a technical invalidation point. The correct way to use order pairing is to place it inside a structured process. The correct way to use order pairing is to place it inside a structured process. Start with the higher time frame narrative. Determine where price is likely being delivered. Identify the liquidity that may support the institutional transaction. Mark the key level where the reaction may occur. Observe how price behaves when it reaches that level. Then wait for the market to confirm your idea through an engulfing bar, a key reversal candle, strong rejection, displacement, or another confirmation that forms part of your tested model. Order pairing helps us understand the transaction. The key level gives us the location. Liquidity explains why price may move there. Confirmation gives us the timing, and risk management protects us when the idea does not work. That is how the individual concepts come together as one complete framework. Inside Fundex, I do not teach traders to memorize isolated patterns. I teach them how to understand the reason behind the movement, how to build a directional narrative, and how to wait for evidence before committing risk. Because long-term consistency does not come from finding one perfect candle pattern. It comes from following a clear process repeatedly, managing risk correctly, and accepting that not every market movement is your trade. Before your next entry, ask yourself these questions. What is my higher time frame direction? Which liquidity is price targeting? Is price trading from a meaningful fair value gap, order block, or institutional level? Has the opposing liquidity been taken? Does the order pairing support my directional idea? Has price provided a valid engulfing bar, key reversal candle, or displacement confirmation? Where is my technical invalidation point? And is there enough room for price to reach the intended target? When you can answer these questions clearly, you are no longer entering because of one candle. You are executing a complete trading plan. If you are tired of jumping between strategies, and you want to learn how to combine market structure, liquidity, order pairing, institutional levels, and confirmation into one clear process, applications are now open for Fundex Masterclass enrollment. Inside the program, I help traders develop a structured framework for analyzing the market, executing with greater confidence, managing risk, and approaching prop firm challenges with a professional process. You can find the link to apply in the description below. And if this video helped you understand how to use order pairing correctly, subscribe to the channel, like the video, and let me know in the comments which trading concept you would like me to explain next. Remember, order pairing gives you context, the key level gives you location, confirmation gives you timing, and your process determines your consistency.